with all we're seeing today and the fact that the S&P is actually fractionally lower for the year, what's giving you the confidence to make that price target projection?
Well, Frank, yesterday's market was a wake-up call for investors. If we stayed and look at the longer term, though, we've really seen an amazing run in the market. So a little bit of a pause, it should not be surprising. November through January, if we track those markets, we've had an incredible rally. I think that what we are seeing, our investors are taking a hard look at the reality that we've woken up in January and understood that the vaccine is coming, but it's not going to be here that fast. That relief is coming, but it's not going to be $2 trillion worth. And so we're back to basics of block and tackling. Some of those big names, super cap, that are selling off right now, we've seen investors begin to take that rotation. Cyclical sold off also yesterday. So there's a little bit of a reality that we're going to be stuck with technology and stuck indoors for a while. But the bigger picture says that equities with interest rates this low are actually still attractively priced.
So, Rod, you say that there's also potential for this market to be a bubble. And as you mentioned, this week and today, we're seeing these tech earnings or tech stocks fall after their earnings. And as I said, the S&P down fractionally for the year. What is creating this bubble-ish perception in your mind, while at the same time you have that projection for the price target for the S&P?
Well, listen, we're all stuck at home. Mobility is down. We've got a lot of people who have a lot of time to look at the internet, to look at their personal devices, to be spending on their tablets. And so, of course, technology, our life is all about technology right now. But again, if we look at those valuations, investors should be looking for places where we can expect some attractive returns. And so for that segment of the S&P 500 that has dramatically outperformed, there's still an awful lot in the S&P and in small caps and mid cap stocks that have not outperformed, where valuations remain attractive. And so we spend a lot of time focused on that upper cap tier, those mega caps. If we come down a few levels, there's still some place for investment. There's still some place for return expectations. We think we'll get through this turbulence, but yesterday was a bit of a wake-up call that there will be market volatility ahead.
So, Rod, why would we rotate away from those mega caps, tech stocks and consumer discretionary stocks that really push the market further in 2020? I mean, U.S. equities had a 21% return in 2020. Why change up now?
Well, listen, we've already seen that change up start. If we were to look at the first couple of weeks of January for some clues, we began to see that the tech stocks, the big winners of last year, were actually lagging some of the value stocks and things that were recovering. The cyclicals were coming back. So I do think it's important for us to understand it was the stay-at-home basket of technology that is getting us through this COVID regime. And we're not through yet, and the markets understand that. So there's still good support for technology. But as we come out and we get the mobility trade started, as we get into the next quarter and the following quarter after that, we really should see cyclicals recover. We really should see some opening, which is going to help with consumer discretionary. It's going to help with those smaller cap companies. It's going to let us get things going again. And so we see great value there. Overseas, we're also seeing some incredible opportunities in emerging markets, in small cap international value. There's a lot of places there where we have not seen this big tech bubble focus.
And Rob, before we let you go, we have to ask you about some of this activist retail investor movement, the activist retail investor movement that we're seeing that related to GameStop, AMC, and some other stocks. How do you see this impacting the markets right now, and could it lead to a broader sell-off?
Well, right now it's causing some real challenges, and those challenges are particularly challenging or particularly difficult for the hedge fund folks, the professional investors who are looking at valuations and saying this doesn't make any sense. And those that are short covering are having to cover those. They need to sell some good stuff to take the cash to pay for it. So this cycle, we call this the gamma trade, it could continue for a little while longer. And so this is a dangerous time for the markets, but we'll get through this. And I think, unfortunately, there's going to be a little bit of a bubble bursting for some of the really speculative, small micro cap tech names. We'll see what happens with those in the coming month.
Shepard Smith here. Thanks for watching CNBC on YouTube.